Welcome to today's ACAMS web seminar, Understanding the Impact of the FATF Revised Recommendations on Local Anti-Money Laundering Regulations. I am Carleen Mack, the web seminar producer at ACAMS. Before we begin, I would like to remind you, if you experience any technical difficulties during today's session, please feel free to send a message through the Q&A box and we will try our best to assist you. If you still experience technical difficulties, please contact WebEx Technical Support. The number for U.S. and Canada is 866-229-3239. For international attendees, the number is 916-229-3239. Also, the link to download today's presentation can be found in your materials and login instruction email. Now to begin today's web seminar, allow me to introduce our speakers. Zia Ullah, Partner, Regulatory and Compliance Advisory, Pannone LLP, David Blackmore, Director, DB Risk and Compliance Services, Mark Dunn, Market Planning Manager, LexisNexis International Business Information Solutions. It is my pleasure to welcome our speakers. I will now turn it over to you, Mark.
Thanks, Colleen. Yes, and good afternoon to those people who've joined us in Europe and outside the States, and obviously good morning to those people in the US. Today's session is to focus on the FATF revised recommendations. These were issued in February of this year, and obviously, given the influence the FATF has on international anti-money laundering legislation, they no doubt will start to impact local legislation over time. So what we'd like to do on this session is take you through at high level what the proposed revised recommendations say, have a look at the practical implementation and possible issues with your own compliance processes that you may want to consider. And then what I'd like to do is focus on one specific issue within the recommendations, which is around transparency and beneficial ownership. Now, Zia Ullah will join us shortly, and he'll take you through an overview of the key changes. But I'd like to begin by handing over to David Blackmore, Director at DB Risk and Compliance Services. David has extensive experience working with banks, both in a compliance role, but also consulting around areas of financial crime and anti-money laundering. And we'd like to begin the session really by focusing on the key areas you may want to consider for your own compliance process. So I'll just move along the presentation to that point, and we'll begin the session today. Okay, over to you, David.
Well, Mark, thank you very much indeed, and welcome to everybody. This is going to be a considerable challenge for us all, given the fact that FATF has already put it on record that they're going to be conducting mutual evaluations from the end of next year, which is not a lot of time for members of FATF and member states of the EU and other major jurisdictions to get their changes in place so that we avoid a big expansion in the number of deficient jurisdictions. I thought it might be helpful to start if I could just rerun FATF's declared objectives in what they're about and have been about now for 20 years or so. What they seek to do really is to set global standards. It's an intergovernmental body, as we're all very well aware, and they do this by identifying the risks and then develop policies to address those risks. They aim to coordinate international efforts to prevent and forestall money laundering, terrorist financing, and of course the financing of proliferation, both of weapons of mass destruction as well as conventional armaments. And then of course it's encouraging jurisdictions to apply preventative measures in the financial sector. So it's really an enabling body for countries to establish powers, plus bolstering the efforts of the competent authorities by enhancing transparency, availability of a lot of information, and I'll leave the beneficial ownership question in details to Mark, but also to facilitate what is so often lacking for many of us who are practitioners in this area, and that is the degree of international cooperation that we'd all very much like to see. Now, the most important thing, which I think will occupy a great deal of effort at jurisdictional as well as institutional level, is the global application of the risk-based approach. This is going to be difficult for some jurisdictions who've been used to a rules-based approach. One of the challenges is going to be uneven implementation over the next 12 to 18 months. So it's going to be a major undertaking, a major challenge for senior management, for boards of directors, as well as those responsible for day-to-day compliance, because what we're going to move to, just move back a bit, sorry, what we're going to move to is the exercise of judgment, which will replace box ticking. And firms operating cross-border are going to have a bigger challenge because there will be some jurisdictions in which they operate which do not currently have a risk-based approach. There's also going to be, the size of the challenge will be greater because of the addition to the recommendations. As you will all know, the 40 plus 9 have been reduced to the standard 40, but indeed counter-proliferation and international financial sanctions, which of course is a very, very big and live issue globally at the moment. What we don't achieve, or what we used to achieve through armed intervention and sometimes war, is now hopefully going to be achieved by international diplomacy and the application of sanctions. So that's going to be a major challenge for the new recommendations to take effect. Plus, of course, to prevent abuse of non-profit organisations. Some of us would call them charities or non-governmental organisations, but suffice to say there is some considerable evidence around that these have been abused for terrorist purposes. Again, quite a challenge for identifying and dealing with these organisations, particularly when the enhanced recommendation on beneficial ownership comes into being. Now, something else which has occupied a great deal of regulators' attention is the revised definition of politically exposed persons, or PEPs. This time it's going to include domestic politically exposed persons and those in international organisations and those that are associated with the risks of corruption. Now, this is going to be a major change, particularly where we are in the European Union, where an historic compromise of about 7 years ago excluded domestic PEPs. I have to say, personally, I have never understood the logic for that, although our own system does include provision for some politically exposed persons who are located locally to be included within due diligence because they pose a higher level of risk. And under a risk-based approach, that is, of course, a significant area where the risk-based approach has an advantage over rules-based. I should also mention that we're including this time tax-based crimes as predicate money laundering offences. That's going to have a big challenge for those jurisdictions involved in wealth management, trust work, and dealing with individuals of high net worth, because in some places tax crimes, as we understand them in much of Europe, are not necessarily recognised elsewhere. So the likely issues going forward are going to be implementing this risk-based approach. It has certainly been a challenge in the UK and elsewhere, and particularly the focus on terrorism is going to make that much greater, simply because around the world the understanding of what terrorism actually is does indeed vary significantly. So hopefully what we will have from our governments are certainties on these matters to enable us to have a coordinated approach. Hopefully, as far as the EU is concerned, we understand that policymakers are now working on a fourth money laundering directive, and the aim is a draft by the end of this autumn, which we will hopefully see, and either a directive or a regulation by the end of 2013, which will give precious little time for member states to upgrade their own legal frameworks in order to get the new system underway. I should just stress that FATF are very clear about their intended, and I won't say enforcement, but their evaluation of countries' systems will begin from the beginning of 2014. So we all, this is not something which can be left, and I do strongly advise firms worldwide to really get to grips with these considerably reinforced changes to make it happen. And for global banking and other groups, a significant management challenge for which we ought to be preparing now. How do we do that? Well, as you will see on the slide, the first thing I think is to do a documented gap analysis to the new recommendations, upon which we can then review our risk assessments, because the risk assessments will actually be the foundation of everything else that we do. They impact upon due diligence requirements, our policies and procedures in that area. They impact upon training, impact upon monitoring, impact upon staffing and recruitment. So it is once the risk assessment's in place, it is a major step forward to implementing everything else. And as we found in the UK in particular, this is not an easy thing to do, and it does need, crucially, and that's why I would want to emphasise the last bullet there, it really does need the involvement and ownership and drive of senior management right from the top. This has to be something where the board of directors or other controlling organisation is really on side and will drive this process of change. We're seeing in the UK and in many other jurisdictions, the US in particular, that senior management is a #1 target for regulators. If they're not involved and not seen to be demonstrating compliance, then the degree of enforcement is likely to get wider and more onerous as time goes on. So it's a major challenge, and hopefully we will be starting now in order to amend policies and procedures, look at our monitoring program, mainly, of course, hopefully with the aid of technology. There's a lot of very helpful commercial products out there, and find ways of demonstrating the ongoing effectiveness of our risk-based approach. Because one thing to remember is a risk-based approach in 2013 is not necessarily set in stone for all time. It does need constant review and tinkering as our products and services might change and the dynamics in the markets that we operate in might change. So what I would recommend to firms is to take a holistic approach to financial crime and not keep it separate from fraud or insider dealing, market abuse, sanctions violations, all of those things. I can certainly say from personal experience that the holistic approach is a big challenge, but I think it has a number of advantages over what I would call the silo approach.
Okay, thanks very much, David, and some very useful insight there, and obviously some good suggestions on how you may want to review your own internal compliance processes now in preparation for these new recommendations coming into local legislation. I can see a number of questions coming in to the panel, and obviously do keep sending those in. What I'll do now is just focus on one aspect of the revised recommendations, and this is the area of beneficial ownership. And then we'll finish with a recap from Zia on the high-level changes, and then open up to questions. One area, as I said, which the recommendations focus on is beneficial ownership. Now, this isn't anything new. It has long been part of the FATF recommendations. And the link between beneficial ownership and financial crime has been known for some time. Obviously, different company structures, in some cases, really help facilitate the hiding of illicit gains and the proceeds of crime. And you can see on the slide there a number of quotations, really just trying to illustrate how bad a problem this is and how long it's been going on for. It's long been recognized now that beneficial ownership and corporate structures and financial crime largely go hand in hand and help the criminal fraternity. One thing that's been done as well is pretty much an entire forest cut down in producing numbers of white papers, reports, recommendations, reviews on this issue. I mean, going back to 1988, when this was really first formally picked up. And you can see there's been lots of reports and lots of focus on this since. But what we haven't yet seen is any drive to make beneficial ownership data publicly available and more transparent to the compliance practitioners. So this whole process of trying to identify the beneficial owner is obviously much easier. That is yet to happen. And one reason I'm focusing on this subject with the recommendations is that it looks like there may be some light at the end of the tunnel, and we can look at this now. Okay, just to put this in context a little bit more, there was a report in April by the European supervisory authorities. They did a quick survey of different European countries to look at how transparent beneficial ownership data was. I won't kind of labour the point, but basically the report found from across the European Union there wasn't really much data available. So for example, this first slide, you can see examples there of where this information isn't available. The lack of data in certain jurisdictions on legal entities, legal arrangements and trusts, again, few countries providing access to that. Looking at other legal arrangements and trusts, again, for most countries, it's the norm not to provide beneficial ownership data and make that easily available. And going on to other categories as well, which the survey picked up. Again, this isn't the norm in different jurisdictions. Access to this data is not available. So just finishing off there, looking at third-party intermediaries. And again, the norm is that beneficial ownership data just is not there in the public domain. Okay, so essentially what it means, obviously, is that is a problem, but I think if we look further afield, and most of you, no doubt, doing a lot of due diligence into high-risk emerging markets, that's where all the growth is, as we can see from the GDP map on the screen there. But unfortunately, if we look at the Transparency International map underneath, that's where all the corruption is as well. So sadly, a lot of those new emerging markets also have a bad track record for corruption. So the need to do due diligence is even greater, but unfortunately, access to beneficial ownership data is even harder to find in some of those emerging markets. So I think I've probably said enough about how bad the problem is. I think if we now look at some of the solutions and what we're going to do about it, well, to date, as I've said, there's no easy way to verify the beneficial owner. On the one hand, you can try web searches, you can try accessing local registrars, you might subscribe to databases, and if the risk is great enough, you may call on your outsourced risk advisors to go and do some investigations for you. But right now, there's no one-stop shop, there's no one simple answer to accessing this data. Now, what the OECD has done, they've looked at this in some detail, and effectively they came up with three proposed ideas on how countries could actually address the lack of beneficial ownership data in the public domain. So one was basically encouraging upfront disclosure. The other was to encourage intermediaries, so the company formation agents and other intermediaries, to actually hold this data and to collect it. And the other was to put more focus on a more investigative system, so to encourage the collection of this information by various enforcement and other agencies. Essentially, the upfront disclosure option was the one that was favoured, and obviously this is now where the FATF recommends is the option the FATF has also focused on. So basically, if we look at the recommendations, I won't kind of read obviously every line on the page here, but recommendation 24 and 25, the detail around those starts to address the issue. And then if we look at the interpretive notes to go with those recommendations, the FATF have helpfully suggested some ways in which countries can actually now start to look at collecting and making available this information. Okay, so really emphasizing the need to collect the data and then make that available to compliance practitioners. effectively what we end up with are three primary recommendations. One is for financial institutions to obviously obtain this data. The other is for competent authorities, so for example, formation agents, registrars, to hold the information. And another is to encourage companies themselves to make sure they've got this data to hand and it's up to date and available. Okay. And the other there is obviously to look at stock exchanges and various listing agents for collecting the information. So effectively what the FATF recommends is that countries do look at this issue. They put in place a number of those, or one or several of those options to try and address this. I think the concern is that one of the suggestions by the FATF is just to basically review the existing information and see if that's adequate. And in some ways, it almost acts as a get-out clause, because some governments might consider that they already provide good access to beneficial ownership data, and they collect this, and it's there already, where in reality, I think we can all agree that that isn't the case. And hopefully, with the FATF prodding government, we can actually see a change and easier access to this. But I thought I would focus on that specifically because it is an issue that's affected all of the practitioners that are trying to do AML due diligence. It's a perennial problem, and I hope the FATF has now come up with some proactive steps to try and address that. So what we'll do, before we go to questions, I'll just introduce Zia, who's now joined the call. And what we'd like to do is just recap the changes that are coming through from the FATF, just to end the presentation part of this session. So to bring you back up to speed with what the FATF recommendations actually say and what the significant changes are. So I'll just get back to the start of the presentation and I'll hand over to Zia, who will go through this. Okay, Zia, so over to you.
Thanks very much, Mark. Thanks very much, Mark and David, and apologies to all delegates for my late arrival, mix of my end, so apologies from the start. And both Mark and David have dealt with the major issues that I'm going to look at from a legislative perspective this afternoon, and we'll do so in very short time, really, given the excellent way that Mark and David have focused on the key policy and practical areas for consideration. Just looking in summary, essentially, at what the revised FATF standards have changed or have clarified in most respects. The key changes, as I think David has alluded to in much greater detail, relate to the risk-based approach and clarifying for governments and countries in particular what areas they're able to focus on in relation to low-risk areas and areas where they actually should be addressing further resource when considered as a high-risk area. So we see much more talk about discretion being given to jurisdictions in relation to the way in which and the manner in which they can legislate for such high-risk and low-risk situations. As Mark just discussed, one of the key areas for revision has been transparency, particularly the transparency relating to legal persons and legal arrangements, and the manner in which jurisdictions can get access to timely information, as Mark discussed in his summary. We also see revised standards on international cooperation, particularly on the sharing of information between FIU across governments, and linked to that the operational standards to which those FIU should be operating to. David alluded to some of this in terms of new threats and new policies in terms of what focusing on what the emerging threats may well be, even though the FATF have given us a list of recommendations. They also helpfully give us some basic information about the fact that actually it's not just enough to rely on those recommendations, and in fact jurisdictions should always be on the lookout to decide what emerging threats there may well be and ensure they legislate for that. The key ones that David looked at in particular in relation to financial sanctions and terrorist financing are also looked at in greater detail within these recommendations. And finally, we see some clarification wording throughout the document. So just moving on then to what are for me the major and the key areas that FATF have focused on themselves and where we can expect to see some legislative shift across jurisdictions. And of course, it's probably worth saying at this stage that in fact it very much depends on where your particular jurisdiction is in their particular journey when it comes to AML/CTF and the existing or the old FATF recommendations, because some jurisdictions are further ahead than others, and that applies actually even when we look at groups of countries like the European Union. Some are further ahead within the EU than others. So looking, number one, at one of the major issues that's caused much consternation for many years now, but actually has finally seen some agreement and movement, is the list of predicate offences for money laundering having been expanded now to include serious, and the word serious needs to be underlined there, serious tax crimes. So brings that within the scope and the powers that enables authorities to investigate and prosecute offences of money laundering. Again, using the UK as an example, we have an all crimes approach to our money laundering legislation, and therefore any crime can lead to offences of money laundering. That's not the same across the globe, and we'll have to wait and see just how that's interpreted by particular jurisdictions that have held firm in their opposition to tax crimes being included as a predicate offence. The next area where we've seen some movement is on the very important area of customer due diligence. Now, those of us that have operated in the private sector and provided advice to the private sector have known for some time that some of the more difficult issues and the issues that actually Mark spoke to there have related to the identification and verification of beneficial ownership, in particular when looking at legal persons. And so now there's more of a step-by-step customer due diligence process when we look at the revised recommendations. But I expect to see some shift, particularly when we look, and I'll come to this at the end of my discussion, at the 4th EU Money Laundering Directive. Expect to see some movement when it comes to the simplification of customer due diligence, because that's something that the financial regulated sector have spoken about for many years now. So moving on to the transparency of legal persons, as Mark dealt with in some good detail there, the requirements are going to be based around the improving quality and availability of information relating to the company's directors and shareholders. In addition to this, we're going to see nominee directors and shareholders having to disclose their status to company registries or to be licensed, and so reduce the perceived risk, as David mentioned in his talk, to trying to hide behind legal persons and legal arrangements when trying to disguise ownership. Again, there are going to be differing approaches here from jurisdiction, and again, some countries ahead of the pack in terms of where they are with their registries. I think those jurisdictions that have been known historically to be places where people could lay low in inverted commas may well find that actually that becomes much more difficult in this new age of transparency, particularly when we look at the focus on politically exposed persons and corruption. So that takes us handily to the next slide, which deals with politically exposed persons, and one of the key issues that we've seen dealt with here within the revised recommendations are the perceived strengthening of requirements to extend the already required identification of politically exposed persons to apply it not only to foreign politically exposed persons but also on a risk-based approach to domestic politically exposed persons and PEPs related to what are known as international organisations, such as the UN, for example. One of the key issues here, I think, is again talking about differing approaches to this journey. Certainly within the UK financial sector, no distinction has been made from a practical perspective with regards to domestic and non-domestic politically exposed persons, and that just makes common sense. Trying to differentiate your customer book, client book, between foreign and domestic has always presented a great challenge. Also, when we look at the EU, the third EU Money Laundering Directive, and its existing definition of what a politically exposed person is, we also see challenge there in terms of the one-year preceding rule. Again, it falls to be determined whether we see any change to the definition, certainly within the EU Money Laundering Directive. Certainly within the regulated sector in the UK, most, if not all, institutions don't seem to operate that 12-month rule and will just treat a PEP as a PEP from an ongoing perspective. One could argue rather unhelpfully that FATF haven't decided to sanction lists of PEPs at this stage, which obviously may have made that journey a little bit more simplified for those institutions that are a little bit behind the curve when it comes to PEP screening, but it's said that further guidance will be provided, which obviously is welcome in relation to how to identify a PEP and their family members and close associates. Often it's not a PEP that's the difficulty in terms of identification, it's actually the family members and close associates and how far and wide one goes to bring those into the suite. David spoke eloquently in relation to UN sanctions, and we see a formulated recommendation regarding the consistent and effective implementation of United Nations sanctions. So we don't go beyond UN sanctions at the moment relating to terrorism and the proliferation of weapons of mass destruction, which from a practical perspective shouldn't make it too difficult for jurisdictions. This is something they should have been doing for a while now. To the extent that they haven't, because they're limited to these two particular areas, it should not be too great a practical consideration for them to implement for those jurisdictions that are yet to implement, of which there are only a minority, as far as I'm aware. One of the good things, I think, from a practical perspective was to see that we no longer see the differentiation between the 40 and the special 9 recommendations. So we see integration now of all the special recommendations on terrorist financing within the 40 recommendations itself, showing the link between AML and CTF, that those of us who've worked there have always worked on that basis in any event. As I mentioned earlier, in terms of the area of focus, exchange of information is seen as a key issue here, and again, the Egmont Group has been particularly vocal in this area and tried to highlight some of the successes that it has had in terms of the sharing of information between investigative, supervisory and prosecutorial bodies at the international level, and that's also been focused in relation to how they can relate that to asset tracing, freezing and confiscation of assets when successful prosecutions occur. That's also linked to slide 8, improving operational standards, because we also see that there is also a view that some jurisdictions need to improve their game when it comes to the operational standards that law enforcement and FIU are operating to, so that we see much further clarification of who's responsible for what when it comes to AML and CTF, and what legislative powers should be made available to them. So that's going to be interesting from a legislative perspective, just to see how, again, those jurisdictions that may not have actually implemented complex legislative requirements when it comes to FIU, and they're linked to their anti-money laundering and counter-terrorist legislation historically, how they in fact change that practically. There's also within the group, interestingly, within the recommendations for me, been an interesting focus on the requirements of financial groups, and so stating, and again David alluded to this in his holistic approach argument, that financial groups need to ensure that they are looking across the globe in terms of how they're going to implement any requirements that are promulgated down from their particular jurisdiction, so that head office functions need to focus on their particular jurisdictions, not taking their eye off other jurisdictions in which they operate, of course, but also making sure that the head office, the global head office, incorporates disseminates its policies and procedures to its branches and subsidiaries across the globe. And again, one of the areas of challenge that we've seen some difficulty with is where there is a conflict between the CDD requirements within particular jurisdictions. And again, it's going to be interesting to see how that is implemented from a practical perspective when it comes to legislation. And in terms of one of the final areas of focus, transparency. Well, we've spoken about transparency of legal arrangements, legal persons in some detail, but actually enhancing transparency of cross-border wire transfers. And I've seen that there's a question from one of the delegates in relation to Special Recommendation 7, how that's been implemented within the revised recommendations, and I'll await the dealing of the question when we look at that. But essentially, I think further focus on wire transfers because it's seen as a particular area of risk for financial institutions, no matter where they operate. So just seeing that is actually a key issue for us going forward. So finally from me, from a selfish perspective, one could say, in terms of operating within the EU, and what are the key challenges going to be in terms of how these revised recommendations impact the existing third money laundering directive, and what will we see in terms of the fourth EU money laundering directive? Well, the timing of both the FATF recommendations and the consultation on the EU MLD were pretty similar, so we saw actually not much difference in approach when it came to the EU MLD, and actually there's nothing too controversial in what we might see in a fourth EU money laundering directive. I think we're going to see further clarification of the application of the risk-based approach to AML and to the degree possible CTF, and just who will be expected to comply. When I talk about scope there, that's what I'm talking about. Who will it cover? Will we see an extension? I doubt it. One of the key areas has been when and where can one apply simplified customer due diligence, and I think again one of the key areas that the EU focused on in its review was the fact that some jurisdictions had taken simplified customer due diligence to mean no customer due diligence, which of course it's not meant to equate to at all. So I think there's going to be a clarification in relation to that. Also, the definition and approach to politically exposed persons and beneficial ownership, well, they're going to have to be revised as a result of the FATF recommendations. So again, I would expect to see some movement in terms of how particularly the registration requirements are phrased within the EU MLD. And then finally, from my perspective, we may, and I say may in inverted commas, may see some further clarification in relation to how the directive will be applied to legal professionals. And again, that's interesting not only for lawyers, but in terms of the potential clients of lawyers. One of the key issues that we've seen during the implementation of the third EU directive and the consequential legislation surrounding it from a money laundering perspective has been the perceived, and I say perceived again in inverted commas, perceived encroachment into the issue of privilege and just what information should and should not be privileged, and just when and where the AML directive should apply to legal professionals. So again, we may well see some change in relation to approach within that when we come to the fourth EU money laundering directive. So that's it from me. Once again, can I apologise profusely to all the delegates for being late, and to my fellow panellists, David and Mark, who coped admirably. I'll hand over to you, Mark.
Thanks very much, Zia. That's a great recap of the key changes. So whilst we've all been presenting, there have been quite a number of questions that have come in which we'll start to take a look at now. If there are questions we don't manage to answer today, or if there are questions you think of after this session, obviously do send those on to Carleen at ACAMS, and we can take a look at those after the event. But I'd like to start by looking at one question around PEPs, and it would be great to get some views on this from the panel. If the definition of PEP changes, or rather, let's see if I can read this correctly. Yes, if the definition of PEP changes, how should a bank clean its book with existing domestic PEP accounts? So I think the question there is obviously if the domestic PEP ruling or change comes into local legislation in some of these jurisdictions, how should a bank tackle that? Now, perhaps if I can call on David or Zia, maybe to give some advice on how a bank would go about reviewing its existing customers to check for domestic PEPs.
Zia, if it's okay with you, you with your large bank prior experience and me with a number of small institutions before I went into consultancy, all I can say is the risk-based, this is the epitome of the risk-based approach, because if it's decided in local legislation to comply with FATF, then automatically you would be wanting to review your current customer base to see if you are onboarding PEPs and maybe to do some enhanced due diligence on them accordingly. And once again, this is a dynamic situation. I mean, we have a classic example at the moment. A former, in the American elections, for example, former US President Bill Clinton, very much back in the political spotlight in the convention at the moment for the Democratic Party. Similarly with Tony Blair from the UK. Many firms that I'm aware of say once a PEP, always a PEP. So my short answer to the question is yes, review your domestic book, take action accordingly, and keep your information up to date. And that might mean, in addition to requiring further due diligence from the individual customer, it might mean, for example, using open source IT, Googling or similar application to get information which might put you on notice if questions need to be asked and further action needs to be taken.
Hey, thank you, David.
I'd agree with that, and just making that the differential between small and larger institution. From a larger institution, and again alluded to when I was just chatting there earlier about from a practical perspective, actually those that operate globally have historically chosen not to make that distinction, because obviously what may be, particularly when we talk about the EU, what may be a domestic PEP for someone based in the UK, so Tony Blair, for example, for Barclays, RBS, etc., may well not have fallen within the definition of the foreign PEP for those institutions at home, but obviously their foreign branches, if they maintained accounts for them across the pond or across the continent, they would have been a PEP, a foreign PEP. So you can see there a good example of it not making sense to try and delineate between domestic and non-domestic PEPs from a global financial institution perspective. I can understand that people have wanted to historically cut down as much noise as they could in terms of what they did with these vast PEP lists that are available to disseminate. But ultimately, again, as David has mentioned, the risk-based approach means that you're going to have to start looking at your book in totality now and decide the extent to which you think you need to look at it and screen it against PEP lists that or other lists that are information available, again, that David disseminated in relation to Google, etc. So it very much depends on the size of organisation you're looking at, the types of customer you're looking at, the numbers, all those things need to be factored in to deciding probably the frequency that you look at your book when it comes to PEPs. The perception has always been, historically anyway, that there wasn't a need to screen your PEP lists to the same, anywhere near the same frequency as you would sanctions lists, as an example. But whether or not that changes in the new environment, we'll wait and see.
Yeah, and I think, talking from the kind of vendor point of view, obviously, which LexisNexis is, a core part of this is obviously the underlying software that's being used for the screening process, having a look at the classifications you've got for your existing accounts and whether they need to be amended to reflect this new status. And obviously, with that software, being able to audit and demonstrate that changes were made. So if you need to try and prove to the regulator that you have looked at this and you've taken action, you've got an audit trail you can show to that effect. But moving on, we've had, understandably, given the how much of a problem this is for most of the practitioners out there, we've had quite a few questions about beneficial ownership. The first is, should someone decline a customer relationship in absence of clear beneficial ownership? And I guess, well, from my point of view, it depends on the jurisdiction and obviously the legislation in place. In Europe, identifying the beneficial owner is a requirement, obviously with the 25% threshold. Elsewhere, it may not be focused on it as much, but I think, again, it'd be good to get a view from David and Zia on that.
Okay, Mark, I'll jump in first if I may. I think as a general policy, I would certainly advise that if it's the client or the potential client themselves that are declining to provide information, then this may well be an initial cause for creating a suspicious activity report, because the obvious question is, why are they not prepared to disclose beneficial ownership? So that's one area. But certainly in the EU and certainly UK regulations, if the beneficial ownership is not completed within a reasonable time, then we are mandated to, not to proceed with that relationship. I think it's also good banking practice, actually, if you don't know who your customer actually is and who you might want to be lending to, then it's pure prudent banking, let alone the requirement of AML legislation. So I would strongly suggest that when these new rules come in, it will depend to some extent on your own jurisdiction, but as a general prudent banking principle, my answer to that question would be yes.
Yep. Again, Zia, any take on that in terms of...
Yeah, I totally agree with what David said there, and ultimately it is within the EU in any event, it's a regulatory requirement. So if you're unable to complete, because then the obtaining of the beneficial ownership information is part of your ongoing customer due diligence measures, and if you are not able to conduct that customer due diligence on your customers and clients, etc., then you are obligated to cease that relationship and consider whether actually, in fact, a suspicious activity report should be submitted.
Yeah. No, that's certainly good advice there. And again, on the similar theme, a couple of questions that have come in here. Sometimes the ownership changes, which doesn't come to the notice of the bank. In this case, how should the bank cover its risk? And I guess related to that, can we start looking at an example of a mechanism so that beneficial ownership can be kept up to date? I think, the two things do go hand in hand. Obviously, one, how does the information, how is it kept up to date and collected, and secondly, obviously, how are you then notified as an organisation that ownership has changed? Talking about the mechanisms, the presentation that I went through picked up on the OECD work, which was done on this area, and the three recommendations they put forward on mechanisms to look at the collecting of beneficial ownership data. And I think, as I said, the main focus at that time was on upfront disclosure, so really getting companies to actually file this information at the local registrar, and to do that as a regulatory requirement, make it a fundamental part of the information that is filed with the company registrar. So when somebody comes to look at that information or needs to do due diligence to verify what they've been told, it's available to them, and they can actually go and get that. Now that's easier said than done, because obviously some beneficial owners may not want necessarily their identity disclosed in that way, but essentially that's the recommendation that was taken forward by the FATF, and one of the things they're really focused on, trying to encourage governments to adopt. So I don't know if there's anything, perhaps David or Zia, you want to add to that.
I'm just conscious of the time for our delegates out there. I would simply say that the mechanism that I know best would be a periodic review of customers on a risk-based approach, and in particular, maybe include it in our terms and conditions, that the bank has the right to have information on a regular basis. Look at the media. I think relationships should obviously be reviewed periodically, maybe initially after about a few months, depending on the level of risk that you perceive that client to pose. And for companies, I would say as a minimum 12 months. And if you're lending to these customers, then absolutely critical, because you're going to be looking at changes to your mandate, who can give instructions, you're looking at board resolutions, because the corporate environment does change quite radically, mergers, acquisitions, etc., etc. So it is quite critical, particularly when companies are owned by other companies. I always advise clients, get to the bottom of the ownership change, because companies don't own companies, people do. So you need to pursue the ownership change unless and until you get to the people who run the show. And we've had a lot of work to do in this country in order to arrive at that position. Not always easy, but we do have to train our staff to persevere in ever such a nice way to get the information, so that we can then demonstrate to a regulator we've actually got the risk under control.
Okay, I think perhaps if we move on to one other point, we've got a few minutes left. I mean, there's a couple of questions here around what actually constitutes serious tax crime. So firstly, if there are examples of what a serious tax crime would be defined as, and secondly, to support that, has the FATF issued any kind of guidance actually outlining what they consider is serious tax crime for consistency? I don't know whether you're aware of that, or whether there are examples you can give.
Well, so just dealing with that, I mean, it's going to be for jurisdictions themselves to determine what serious tax crimes mean. But a good example of what it may mean from jurisdiction to jurisdiction, depending on how they adopt it, will be if, for example, there's a sentence of imprisonment of greater than, say, 12 months, or in fact it attracts a sentence of imprisonment at all, is one of the ways that they may well choose to define what a serious tax crime is, rather than look at, putting in individual offences, drawing up a list of individual offences. Rather than doing that, it makes it much more complex. They'll probably just look at, if it's greater than a particular term of imprisonment, or it attracts a term of imprisonment, that would then make it easier to define what a serious tax crime would be. Okay. But again, I mean, it depends from jurisdiction to jurisdiction. So, as I said, within the UK, we have an all crimes approach. So, whether it's cheating the revenue out of 1 penny or cheating it out of £1 billion, you still face the same issue.
Yeah, no, I think that's a fair point. I'm just looking at the questions. If there's perhaps a final question we can pick up on. Yeah, one here actually specific to insurance companies. The inquirer is wondering to which extent FATF takes into account some of the questions of insurance companies regarding PEPs. So, for example, how to view a case where the client in itself is regarded as very low risk, but where we identify one of the directors as a PEP. So again, I guess it's down to risk-based approach and policy, but perhaps Zia or David, if you want to comment on that.
Zia, do you want to go first?
I don't think that FATF specifically looks at insurance companies as a particular sector to focus on. I think it just looks at all financial institutions and the regulated sector, and where relevant, talks about high or low risk industries. And I don't say that insurance falls within either high or low risk. I think it's just one of those generic industries, a regulated industry that needs to focus on its particular risk depending on what the institution looks like and what the customer looks like. So if the client itself is low risk, I mean, I think the question would be, it would be interesting to see how you determine client as low risk when you do have a director that's high risk. Well, again, I'll take that back. Actually, some people will be shouting at me now. Where you've got directors of PEP who may not necessarily mean it's high risk, but what you're asked to do in those situations is consider the extent to which enhanced due diligence is required on that particular director, and then decide whether in fact it impacts your classification of the client as low or high risk.
Zia, I think Zia's got a very good. Yeah, I think Zia's got a very good point, because one of the rules of thumb which I sometimes advise clients to do is to have a look at the status of that particular director. Do they actually have power to move resource, or are they on the board of directors merely as, how shall I put it, decoration? This is often the case in continental Europe, where you have a two-tier board structure. For those countries that have that structure, then usually the supervisory board routinely has PEPs and local politicians on those boards, but they don't, as a general rule, actually have power to move money and move resource. It's the operational board that actually does have that power. So I think Zia is absolutely right. Identify the person, but do they actually have the power to move money? What you need to do is demonstrate to a regulator you've actually acknowledged the risk, identified it, taken due diligence, recorded it, because record keeping is critical in all of this. And I also saw that there was a question there from an OGC, or the Gulf Cooperation Council, where often organisations have heads of state and PEPs on their boards routinely. Well, I understand the problem. I've worked in that area of the world, and it is a problem, but you have to do it. And it doesn't necessarily mean to say that all of those honoured persons are high risk, and they're certainly not terrorists, but you have to demonstrate that you have identified them as local PEPs and have conducted such enhanced due diligence as you're able to do, and maybe speak to them, find out some way of having a dialogue so that you can keep track of their involvement in the entity and what role they actually have. I mean, obviously, folks, the big risks in some of these structures is not just AML, it's also corruption, bribery, etc., which now, of course, is another big issue for regulatory firms all over the world. And I'm just hoping, Mark, that if we've been unable to answer all of the questions, that maybe we can collaborate after this event in order to satisfy our clients' requirements.
Yeah, certainly, David. I think, as we're now reaching the end of the session, we will look at those questions we haven't had time to answer today. And as with the previous session we've covered on this subject, we will follow up with ACAMS and send responses to those. So I'd just like to finish, before I hand back to Colleen, just to say thank you for attending today's session. I hope it has been useful and has given you some practical insight and some food for thought for your own compliance process. Thank you.
Great. Before we wrap up, on behalf of ACAMS, I'd like to once again thank our speakers, Zia, Mark, and David, and the audience for joining us today and sending in your questions. If you have suggestions for future web seminar, please send those to training@acams.org. Also, we appreciate your feedback, so please take a few minutes to complete the survey that will appear in your browser at the end of the web seminar. That concludes our web seminar. Thank you, and have a good afternoon.